Hello, this Accounting 2208 Chapter 15 video tutorial will review accounting for shareholders' equity via Extra Problem 15.1 El Paso.
The data set for this problem is fairly straightforward. We're presented with a beginning balance sheet and then a whole series of transactions which we have to journalize. The best thing to do with these accounts as presented is make a T account for each one of those accounts, and as we go through the transactions you can then post each of the transactions into the respective accounts, and so when the time comes to generate or create a balance sheet, we'll have all the necessary information to reconstruct our ending balances for each of the T accounts, and then we can turn them into a closing balance sheet.
Okay, so we'll just briefly review the items or the details that we have. The capital structure of El Paso at December 31st, 2017 includes 5% bonds payable that are due in 2025 with a balance of $1,060,000. There are some preferred shares. They're $4 non-cumulative. The $4 means that's what they pay for a dividend. There are 100,000 shares authorized, 20,000 shares issued, and the carrying value of those is $1,600,000. There are common shares, unlimited authorized, and 200,000 shares issued and outstanding for a carrying value of $2 million, and the beginning balance for retained earnings, beginning meaning for the beginning of 2018. This was the ending balance of retained earnings from 2017 is $2,150,000. So these are amounts that are going to be carrying forward into 2018.
Okay, for our first transaction dated January 4th, El Paso issued 5,000 common shares and 5,000 preferred shares for a total of 327,000. This, in essence, is a lump sum purchase or lump sum issue of shares. And this is not unlike the purchase of, let's say, land in a building for a single amount when each the land and the building have two separate fair values. So what we must do in this case is figure out how much of this 327,000 is allocated to the preferred and how much to the common shares. And to do that, we have to base it on the allocation based on their fair value. So let's start with the preferred shares. So at January 4th, when this transaction took place, each preferred share was selling at $90. So if I take $90 times 3,000 preferred shares, that gives me a fair value of $270,000. Then for each common share that had a value of $13.50, so 13.50 times 5,000 common shares gives me a value of $67,500. So at that point, what I have here is a total fair value of $337,500, and then all I do is take each of them and divide by that total. So that's what's going on here. 270,000 divided by 337,500, basically 337.5 is about 80%. So 80% is allocated to the preferred shares and the remaining 20% to the common shares. And this actually works out quite nicely to be even. So of the total 327,000 in the purchase, we allocate 65,400 to the sorry, wrong color here. 65,400 to the common shares and 261,600 to the preferred shares. So make sure that you review this particular type of transaction where we're using fair value to prorate. That's in essence what we're doing. We're prorating the 327,000. And to journalize this transaction, then we debit cash because the company will receive cash of 327,000, and then preferred shares is credited by 261,600 and the common shares by 65,400, and that transaction is complete. Okay, then on February 28th, the company repurchased 4,000 common shares at a price of $22 per share. So what we do here is we indicate what the repurchase price was, and this will be how much we pay in cash, right? So this will help us determine what the cash proportion of our transaction is. And so that's 4,000 at $22. So cash of 88,000 is the amount that's received there. Now, then what we have to do is we have to determine what the value of the common shares is, and that is basically the average book value per share. And so if you're wondering, well, how does this $4,000, or sorry, this 40,328 come about? Basically, if you go back to the original data and constructed a T account for the common shares, we would have started with 2 million, and that would be for 200,000 shares. Okay, so 200,000 shares. Then the company issued an additional 5,000 shares in that lump sum purchase transaction. So issued. So that leaves us with 205,000 shares, and those 5,000 shares were allocated $65,400. $65,400. So that means prior to this transaction, the balance in the common share account would be $206,400, and if we divide that by the number of shares, we get $10.08. So this is the average book value per share. Book value per common share. And so that book value times the 4,000 shares repurchased means that the average issue price or book value is 40,320, which gives us a difference of 47,680. So the easy parts of the journal entries are always to hit your cash first, then debit the common shares for the amount of the average issue price. So this is where this common share piece comes from. And the difference between the two, we'll do this in orange, the difference between the two represents the over or under, the overpayment or shortfall, I guess, in the transaction. So this is a case where the company paid more to repurchase its shares than it issued at. So basically, we don't want to say that the company lost money on the repurchase of its own shares, because the company can't gain or lose money on the purchase of its shares. But what happens is we first look to see to apply this debit, right? The difference here is a debit. And so the first thing we look is to see, is there a contributed surplus balance that already exists for repurchase of common shares? We don't mix contributed surplus accounts for preferred shares and common shares. So in the original data provided, there is no prior balance for contributed surplus. So all of this difference of 47,680 goes straight to retained earnings. And that's it for that transaction. The next transaction here is a fairly simple one. On March 12th, the company declared a quarterly preferred share dividend. As stated in the data, the dividend rate is $4, and that's annual. And so if it pays quarterly, we have to take that and divide by 4 to give us $1. The question is, how many preferred shares? Well, if we go back to the original data, we started the year, with 20,000 preferred shares, and in that lump sum transaction, we issued another 3,000 preferred shares. So that leaves us with 23,000 preferred shares prior to this transaction, and so that's how we end up with $23,000. It's 23,000 shares times the $1 dividend, and we're done with this one. Then on April 15th, we paid that dividend declared. Of course, if you look back, I forgot to mention that the journal entry for that was to debit a dividend declared account and credit a dividend payable account. And then at the end of the year, that dividend declared account would be closed out to retained earnings. So the journal entry to pay the dividend is, of course, to credit cash for $23,000 and remove that dividend payable. So what we have in a dividend payable account, presuming that there's no beginning balance in there, we have a $23,000 credit in there for the declaration on March 12th, and then a $23,000 debit on April 15th, leaving us with a balance of 0 in the account, and the preferred dividends are then paid. Okay, then on August 22nd, the company issued 1,000 preferred shares in exchange for machinery and a patent. And each of those has a fair value. So the machinery is valued at $50,000, and the patent is worth $40,000. What we do here is they give you the book value of the machinery, but that's actually irrelevant. So we base these transactions on whichever of the two elements here. So we have assets and we have shares. So whichever of the two is determined to be more reasonably determinable or more accurate. So if we have shares that trade on an open market, those can be reflective of what the value of the shares are and would be allocated to the machine and the patent. Or if the shares don't have an open market, like a lot of companies don't trade openly on a stock exchange, and so they may have a value of a common share, but that isn't really truly reflective of what the value is. So we can have machinery and patents and those things appraised. So we would basically, they are more reliable. The fair value of equipment and patents is more reliable even than shares, because shares are subject to fluctuation on an open market. So you could have a preferred share that today is worth, $5 a share, and then suddenly the stock market collapses around the world and that drops to $1 a share tomorrow or even the next hour. So these are more solid and more reliable estimates, or actually not estimates, appraised fair values. So these are what we use. So the company is issuing shares, so we're going to credit preferred shares. We'll debit the machinery for its fair value of $50,000, debit the patent for its fair value of $40,000, and the sum of those two is how much gets credited to preferred shares. Do not use a different number for preferred shares and then calculate a gain or loss on purchase. I've seen this so many times, it's almost laughable. You can never have a gain or a loss on a purchase, okay? So that can never happen. And there's also no adjustment to any contributed surplus or anything like that, okay? So it's always just debit the assets of their fair value and credit the common shares or preferred shares or whatever you have for the sum of those two, and that's all there is to it.
Okay, next up is on November 28th, the declaration of a 5% stock dividend on the common shares. And on that day, the shares are worth $28. So what we have to do in order to journalize this is we have to figure out how much we need to journalize. So in terms of the 5% stock dividend on the common shares, we need to calculate 5% times the number of shares. Well, this 201,000 shares is basically made up of the original 200,000 shares to start, right? That's what the company started with. Then on January 4th, the company issued 5,000. So on January 4th, they issued 5,000 shares. And then on February 28th, remember they repurchased 4,000 shares. So February 28th, that's a repurchase. So when you do the math, that's 201,000 shares. So 201,000 shares times 5% is 10,050 additional shares at a rate of $28, right? That's the value. It means $281,400. So we will debit dividends declared, right? You could debit retained earnings as well, and that will save you the closing entry at the end, but it's always preferred to do dividends declared. So debit that for $281,400 and credit common share dividend distribution or distributable. That's probably the best word, distributable. Okay, because it hasn't been distributed yet for $281,400. Then finally, at December 31st, the net income for the year is $975,000. So the journal entry for that would be to close, right? This is basically a closing entry here. To close the income summary account for, and because we have net income, right? That means the balance in the income summary account, that would be the result of closing all the revenue accounts, closing all the expense accounts. Remember, you should be familiar with your closing entries. So it would have a credit balance currently of $975,000. So we have to zero it out. So we debit retained earnings for debit income summary for $975,000 and credit retained earnings. And then don't forget that that dividend declared account also needs to be closed. So in the dividends declared, there are two transactions. There was the dividend for $23,000 and then the stock dividend for $281,400. So we need to credit retained earnings, right? Because dividends reduce retained earnings, and debit dividends declared, $304,400, and that represents the closing entries for the year. Now we'll go through and show the preparation for the presentation of the final balance sheet. We're just going to do the shareholders equity section of the balance sheet. Again, so El Paso at December 31st, 2018. We do these in the correct order. So we have some preferred shares, right? $4 non-cumulative, 100,000 shares authorized, 24,000 shares issued and outstanding. And we know this because if we would have kept a T account for our preferred shares and all the transactions, we need to make sure that we have the correct number at the end. So we started the year at 20,000 shares. There were 3,000 issued on January 4th and another 1,000 on August 22nd. So the balance dollar-wise is $1,951,600. Right? So we started with $1,006,000, 261,600 on January 4th, and then another 90,000 on August 22nd. So 1,951,600 is the balance for preferred shares. Next is common shares. So there are unlimited shares authorized and now 201,000 shares outstanding. And the value is $2,025,080, right? And that's calculated by following a T account here. If we, as suggested at the beginning, we started the year with $2 million worth of common shares, issued 5,000 at 65,400, repurchased 4,000 for 40,320, leaving an ending balance of 2025080, and 201,000 shares. And if we wanted to know what the average share price would be, it's $10.08. Now the next item is, and a lot of students forget this, is that stock dividend. Remember, we had that 5% stock dividend. It was declared but not distributed. And this in the solution here should actually say distributable. Distributable, because it has not been distributed yet. Okay, so it's distributable. But it still exists on the balance sheet because it hasn't been closed out yet, right? Because it has not been distributed. So they haven't been turned into common shares yet. The company declared the dividend and it closed the dividend declared to retained earnings, but these shares have not actually been declared yet or distributed. So the common share account is not yet updated, and that won't happen until they're distributed in the next year. And then finally, we have a retained earnings account. If you keep a T account for the retained earnings, trace all the transactions through from the journal entries. We started the year with $2,150,000. February 28th, we had an adjustment of $47,680 for the repurchase. Then on December 18th, this was the net income. of $975,000, and then the dividends on December 31st also closed, leaving an ending balance of retained earnings of $2,772,920. And when we do all the math, the shareholders' equity of the shareholders' equity section of El Paso's balance sheet would add up to $7,031,000. So this concludes the Chapter 15 video tutorial on shareholders' equity. Please make sure that you continue to do as many problems as you can, because we simply can't cover every single problem. And if you have any questions, please don't hesitate to contact your instructor.